Hi, good afternoon, everybody. Welcome. Thanks for tuning in. If you guys can hear me well, if you just put in the comment section below, that'd be great. My name is Alvin. Let me just do a very quick introduction. My name is Alvin. I'm the CEO of EquitiesTracker. We are a investing platform based in Kuala Lumpur. We are also listed on the Bursa Malaysia Stock Exchange. And I'm very happy to be invited here by SGX to be able to share with you guys some of my thought processes or personally what I do when I look at investing. Okay, so I'm just gonna share my screen right now. So you guys can see. Yep. So this is a very quick disclaimer. So I'm going to be talking about in this short section. I'm going to be talking about stocks, obviously, and of course, it shouldn't be treated as financial advice. This is my personal viewpoints here, and should you need financial advice, please speak to your licensed financial advisor. All right, so let's quickly kind of jump into the topic of is growth versus value better? I get this question asked quite a fair bit, and I thought it would be a great, a good topic to kind of talk a little bit about and maybe give you guys my thought processes behind it. Now, of course, I think when we talk about value investing, we cannot ignore Warren Buffett, Berkshire being a very large value fund, right? And Buffett himself being a very successful investor. He always says that growth and value investing are joined at the hip. So I've actually pulled this out from some of his letters to shareholders in '92. He says that really the two approaches are joined at the hip. So really, growth investing and value investing is actually the same. And I do agree with him. And I'll share a little bit about what my thoughts are and kind of the processes that I go through when I'm talking about investing, right? Because why would we be investing if there's no growth at all, right? And really some of the elements that we can actually look at, and really if you look at, I've highlighted 4 points that you should look at to kind of determine whether your stock can grow or not, right? So in addition, he talks about investing or value investing being redundant, right? So if you're not investing, then then you are speculating. That's really what he's saying. So let's look at growth, and of course, not all growth is the same. Not all returns are actually the same. We're also going to be talking about the risk factors as well. So when we talk about value investing, I like to drop the word value investing. It's really just investing, right? Ultimately, I think all investors are trying to seek for something that is selling below its intrinsic value, or what Buffett calls, right? But really, if you kind of focus on the term value itself, what does it actually really mean, right? Value at the end of the day means quality over price, and that's why low price stocks doesn't necessarily mean they're cheap. High price stocks doesn't necessarily mean they are expensive, because we're talking about value, right? So if you think about goods that you have purchased, you pay a slight premium for certain things, right? Like your bag or your watch or your laptop or your iPad or so on and so forth. Really, you are appreciative of quality, right? And to you, even though it's a higher price, but you're willing to pay for that quality. And that's really what we want. The talk is focused on, right? There's no point buying growth stocks if there is no quality, right? Even if you made that justification, you must go in with your eyes wide open. So my thought processes about investing is actually quite easy and quite straightforward. I look at stocks from a lifeline perspective, right? So if we talk about general business life cycles, very simply, right? We hear a lot about startups, right? Startups being companies that have just got listed, they've got a new business model, or they just even have an idea. So a lot of companies start up at that level, right? And that's how all great companies have started, right? In their garage and so on and so forth. So when companies start up at this level, right, really looking at net profit, cash flow, free cash flow, or really doesn't really make sense. These are probably the wrong metrics to measure them, right? Or whether they will be successful or not. But we know if a startup does really, really well, it moves into what we call an emerging great stock, right? That means it's starting to emerge that its business model does work. It's actually, cranking up its flywheel, and it's starting to generate cash flow or revenues, right? Or sustainable revenues and cash flow. So after a company moves up from a startup to an emerging grade, they move on to this, venerable, investment grade, really right at the top. So at this level, investment grade stocks, in my definition, we talk about, they generate consistent profits, they generate consistent cash flow, they start paying dividends, right? They have positive operating cash flow and they have a lot of free cash flow, right? And depending on their leverage factor, they might be they might be borrowing money or they might be in a net cash position. It doesn't really matter now. But that being said, whether you're startup, emerging, and investment grade, all three levels actually have growth. So you could be low, medium, or high growth, right? It doesn't mean that your investment grade doesn't mean that growth slows straight away. Really, where we kind of draw this life cycle here, what I'm trying to say here is that there are different risks attached to growth, right? And it really depends on what you want or what your risk appetite is at the end of the day. So, of course, we've seen a lot of great companies that have become not so great companies, right? So, if you kind of Google Kodak, for example, it was once a great company and then it came back down. So, companies at that level of investment grade can possibly move into what we call a sunset industry, right? And with all the disruptive innovation that we're seeing around us today, it is quite obvious that the past giants may not be the future giants, and that's why we talk a lot about growth, right? But that doesn't mean the current giants cannot continue growing. Okay, uh, so if they don't do well, they move into sunset. Now, of course, when a company doesn't do well, then they typically get shaken up and say, what, that there is a turnaround. So either it's a new injection of management, new injection of capital, or a new business model to approach things. And companies do turn around, right? I think in the last 2 decades, I guess one of the biggest turnarounds has been, a very global stock, which is Apple, right? When Steve Jobs rejoined and, he came out with a slew of innovative products and, they are still where they are today, right? Because of that turnaround process that they went through. So you can almost see that businesses move in cycles. So really, when we're talking about growth, I think one of the first things that you do want to actually determine is where is it that this stock actually sits, because there are different quality levels of growth that we talk about. So of course, the risk levels, I've just highlighted very simply here is that if you're moving in a startup kind of space, it's definitely high risk, right? Nothing is proven. Of course, the slightly safer part would be, you're looking at probably emerging or cyclical type of stocks, and of course, investment grade probably gives you the lowest type of business risk. Now, I'm talking about business risk here. Of course, then you move into sunset and also turnaround. So the turnaround is really a question mark, right? Will they turn around? So with just like startups, we've seen a lot of startups that start great ideas, they fail to execute, and they don't actually move up that chain. Similarly, we see a lot of companies that promises massive turnarounds, but sometimes they don't work as well. So on both sides, there's actually risk as well. So before, one of the good things that I always speak to some of our clients who come and speak to us is really, look at your portfolio today, right? Look at that risk level you are actually taking, because a lot of us unknowingly take risks, when we don't even know about it. So when it comes to risk, right? When we talk about value or growth stocks, really there are a couple of things that you need to really look out for in the stock market, right? Really, it's your capital at risk. That means how much capital are you putting, and the capital at risk really talks about the business risk, right? Is it a sustainable business or not? Can it continue growing, or if it's in a growth decline, can it turn around? The second risk that you have to look out for is actually timing, right? So the ideal situation, which is very much easier said than done, is have a low capital risk and low timing risk, which means that stock prices are generally very low, right? So when you kind of put things into perspective, I really just want to put things into perspective when we're talking about investing in general, and we are investing for growth. You need to really kind of look at what is the capital risk that you're taking, and are you buying at very high prices. Now, personally, as a fundamental investor, capital risk is more important for me, right? Because timing risk is something that is very tricky, right? Sometimes you get it right, sometimes you don't get it wrong. So what you want to do is actually build mechanics around it to kind of reduce your timing risk. So this is where when we talk about growth here, I think we all love like a vertical line growth for stocks that we buy, but we know it's easier said than done. My kind of thought process about growth is this, right? We must talk about risk adjusted returns. So which means that if I'm getting a 10 or 15% growth over a 5-year period, which means that it doubles over a 5-year period, um and I'm investing in investment grade stocks, right? I would consider that as a decent growth, right? Whereas if I want to get 15% and say I put it into a startup company where things are quite unknown and sometimes I get lucky, and even if I get a 25% compounded return, um, sometimes the risk may not justify the return, right? So what is very more important is that purely looking at absolute returns by itself, I think kind of gives us the wrong idea that we need to go for all these high flyers. You don't necessarily need to. Really, you want to kind of focus on risk adjusted growth, right? And that's really the essence of things. So when we look at growth, from my personal experience, I've actually found that there are very clear factors for growth, right? Which means that when you are looking at a business, which means that if you're a fundamental investor, you're actually talking about the business first. There are several factors that actually gives you clue that the business is growing, right? So in terms of investing, even though we don't get our timing right 100%, and that's okay, right? Typically, value investors or fundamental investors are probably a little bit too early in the game, right? So they actually determine growth, right? They say, look, there is growth, right? But sometimes prices don't react immediately and they actually take some time. So of course, there are other methodologies around, right? Where you say, look, fundamentally they're good stocks, but prices haven't moved, market has not recognized it. And then you say, look, I'm going to stay out until when prices are starting to move. Only then I start getting in. I don't think there's a right or wrong answer here. It's a matter of preference and style. One requires a little bit more monitoring. The other one just kind of stick with it and kind of leave it for the long term. So let's look at the 4 factors of growth, and I've actually given some examples of what you guys can actually look at. And very recently, on the SGX market, personally, if I look at a lot of the SGX stocks, versus some of the stocks we have here in Malaysia, we're actually seeing quite a discount in terms of PE between similar industries, right? Which is why I think the SGX market is actually quite interesting compared to its peers among the region, right? For example, if you talk about semiconductor type of stocks, a lot of stocks in this region here are trading at 30, 40 kind of PE, right? Because the growth, the forward growth is really high, or is expected to be high. Similarly, you guys get some really good companies listed on the SGX as well, and they're trading at a fraction of some of the peers of their peers actually trading at different exchanges. So the question is, are some of these stocks listed on other exchanges overpriced, or are the stocks listed on the SGX underpriced or a bit unloved or undiscovered? Now, the four factors that typically generate growth or precedes growth, right? Typically, right? They're actually quite straightforward and quite simple, but they're very business centric, which means that we'll be talking about the business first, right? The first thing is obviously, I think the easiest one, if there is a sudden demand or there's a demand growth in the product that the business is actually selling, right? You're going to get growth. The second one is actually raise in selling prices, which means that average selling prices have been gone on the uptrend, right? And I'll give you guys some examples of what I mean by this. The third one is when a company starts investing in capacity. All right. So, for example, if you're talking about manufacturers, for example, if they say, look, I'm going to increase my floor space, double the size, I'm going to increase my production capacity, double the size. And depending on the management or the, how do I say, the track record of the management, if they've actually done well in the past by increasing capacity, you can kind of take a hint that there is growth to come, right? Now, when I talk about increasing capacity, I'm going to be very specific here. It is not replacement capacity. it is additional capacity to what they already have, right? So you're going to typically see a lot of things like increase in investment in property, plant, equipment. You could see investing in personnel as well. And then this is very much for the existing business, right? For the existing. So a lot of what I'm talking about for growth is growth in the existing business. Now, the last growth segment or factors for growth really is a new business segment. So for example, if I was doing business A, I start moving into business B. So I could be kind of within the same industry. I could move upstream or downstream, or I can move into a completely different business segment altogether, right? And that, that could come from, example, mergers and acquisitions. That could also come from internal R&D that they moved into a new business segment. That's also very possible as well. Or even a new market that they're entering into, right? So that would give them ideas of growth. So there are quite a few examples that I do want to kind of share to give you guys an idea to illustrate what I mean by this, right? But if you're looking for growth, look for these 4 factors, right? And if they do well, these are kind of clues, right? You kind of treat them as breadcrumbs, right? Like kind of leading you to where the company is going to go. So instead of just focusing on the now, really, this is really focusing on forward, right? And we'll move on and I'll kind of share with you. Of course, if at any point, if you guys have any questions, I'm happy to kind of answer them as well. So I've got a couple of examples of increase in demand, right? Or increase in demand or volume. Apologies, actually, I forgot to change the top slide. This is actually iFAST. I think it's kind of been a talk of town on the SGX market because it's remained stagnant for so long. It's hovering at $1-ish, 80 cents, 90 cents for a good 5 years. And only until last year things started to move, right? But if you look at iFAST, really, I guess it kind of captured investors' attention. So it was kind of alert for a long time, and then you kind of see a sudden spike in re-rating of the stock. But one of the things that actually happened for iFAST last year, if you look at their risk profile, it's actually fairly low because these guys have been consistently profitable, right? Regardless of market conditions. So if you look at 2014 to 2019, they actually have been growing, but the price has not been growing, right? That's because their profits have been somewhat quite stagnant. But last year, as you know, it was an unprecedented time. COVID hit, a little bit of a black swan event. Governments responded. We had all these crazy pandemic budgets. Literally, it was just creating money and giving it down to people on the street, right? Not just in Singapore, not just in Malaysia, not just in Southeast Asia, globally that was happening. So there was a big socialist push from governments to react to the pandemic, apart from getting all the necessary vaccines, quarantine, and so on and so forth. But on the financial end, for example, the US created a quarter of all the US dollars they had in 2020, right? So there was a huge amount of money printing that really happened. And this time, instead of sitting with the central bankers sitting down with the guys on Wall Street, they're actually sitting down with the guys, with digital mobile apps, right? Or digital, I won't call them digital banks, but guys like Square and Venmo, where how quickly can I put money into these accounts and how quickly can you push it out to the guy on the street because they need money to survive, right? So all this big push, really what happened gave a huge increase in liquidity in the market. So when there was such a big push of liquidity in the market, what happened was you have a lot of money floating around, and that's kind of what drove stock prices up in 2020 as well. When we are expecting a massive downturn, it was a very, very quick V-shaped recovery. Now in that period, I think a lot of you are familiar with the term FOMO, right? Fear of missing out. A lot of the retail investors, those guys on the street, had a little bit of extra cash. Those who didn't lose their jobs but still had extra liquidity. What they then started to do was like, markets are going up. Let's start investing it now. I have extra spare cash, right? And of course, this was really kind of the saga around GameStop and so on and so forth. And you saw kind of a very big push into guys like iFAST, who actually have a network, a very large network of financial advisors who are actually selling funds. They also have a platform that lists all the funds as well. So their business was very much driven by asset under management or asset under administration, and they take a percentage of that. So because of that big liquidity push, I believe in last year, their Q on Q AUA actually jumped 44.5%. So just to give you guys an idea, so when you kind of see these kind of big demands, you may not see the share price immediately, but you're going to see share prices kind of move back, or that's where we talk about growth, right? So in this case, in the case for I know the previous speaker was talking about this, also Alvin as well. In the case, when it went up $1, $2, most retailers will kind of get, we have this psychology issue, right? The moment we saw something really cheap, but it goes above that, then we say, oh, we'll wait until it comes back down. Now, most of the time when we value type stocks where they've been undervalued for a long time, they will unlikely ever go back to its original share price. So if you are planning to you found a good stock, but you're not willing to buy it now, you must have that built-in psychology or expectation that, look, if I'm not willing to buy it at this price, I'm okay to pay a premium. And I think this is where most retail investors kind of struggle on, because it is very much psychology investing. It's no more rationality. So a lot of times we see, a stock that's go up, I think it's expensive, I'll come back, wait for it. But for a lot of these undervalued stocks that have kind of, we call it a loaded spring effect, typically it's very hard for them to be re-rated back downward unless something really drastic happens. And their kind of business, which I want to talk a little bit about valuation at the end, really is net margin, right? For them to increase their margin substantially, they actually don't need massive increase in their revenue, because most of their cost is generally quite fixed, right? So whatever flows on top really almost trickles down straight away to the bottom line. So of course, I think all Singaporeans would definitely, on your circuit breaker, on a lockdown in Malaysia, we have the movement control order. Nowhere else to spend money. You go to the supermarket because these are essential services, and of course, they've done really, really well over that period. And if you kind of look at SHENG, you have to really look at the kind of number of stores, right? So the number of stores opening will kind of give you a clue, right? A clue into its longer growth term strategy. I think now they have probably 62 or 64 stores in Singapore. Majority of their revenue comes from Singapore. So you kind of need to determine that, for this stock to continue growing today, without the pandemic effect, how many more stores can they open without cannibalizing what they already have existing, right? And because Singapore is quite densely populated, right? Because it's very high rise, so you're actually going to see, how many locations can they more open? Can they actually open more to actually get more revenue and profits going forward? Again, SHENG has always been quite a stable stock. You can see they've got a very, very nice, decent margin here. And last 10 years, they've been continuously profitable, right? And last 10 years, if you kind of look at this at the bottom here, they've actually been continuously profitable. They've continuously paid dividends as well. If you can see this, if I'm just kind of highlighting here up to here, you can see, right? So I would put them right on top under the investment grade. So it's very low risk, but there's still growth. Yeah. Let me just clear this. Okay. So I'm going to go on to the next one. So of course, if you have followed this stock, very decent return, right? You're looking at the bottom, maybe a 2.5, 3x return. So it's actually very safe growth, right? Risk-weighted return. This is generally my personal preference. I prefer these kind of stocks rather than going for startups, right? And where there are a lot more unknowns. The second one is actually a raise in selling prices or average selling prices. I think last year what we saw with the pandemic was a lot of the glove stocks did fantastically well, but the reason why they did well wasn't just because there was just a demand, but that demand actually increased average selling prices. They were no longer selling a glove at 2 cents US cents a piece, right? They're selling at 8, 9 cents, 10 cents a piece. So what happens is that a lot of their profits actually came about as a result of increase in average selling prices, or ASP. So here we have one actually right at your doorstep, which is WILMAR, right? SGX. And they are, they are a fully integrated palm oil player, right? All the way from the end product all the way to the plantation as well. And they are based in largely in Indonesia as well. They have plantations in Indonesia as well. So if you look at CPO prices, which is and I've shown you here. If you look at the prices here, I'm just going to draw. Let me get that. Let me get that pen. Yeah, I'm just going to draw. So if you're going to see here, let me see if I can draw this right. If you're going to see here, this was 2019, right? This is pre-pandemic, right? This is pre-pandemic. That was January 2019, January, yep. And all the way, this is December actually, 2019, yeah. You're gonna see actually on the very quiet side, commodity prices actually has been on the rise over the last 2 years. They almost seem unaffected by the pandemic. So if you look at palm oil prices, you've actually seen that the average selling price has been slowly increasing, right? So in 2019, it was 2,000. It ended the year at 3,000. This was pre-COVID. And then this was 2020. So if I look at my bottom graph here, if you look at this is 2020. Again, this was January. So we started at 3,000. We ended the year in December here in 2020. Still in pandemic, still in a recession. But CPO prices or crude palm oil prices actually went to 4,000. So that's a twofold increase in 2 years. Now, one of the interesting things is this, right? A lot of these stocks actually have not really started to move yet. And the question is, the big question mark, I guess either investors are not noticing it, or the big question mark, when prices go up is how sustainable are they? These are, 12-year high prices historically. So the question is, are they sustainable? If they continue to sustain at these prices, you're going to see something similar, right? Where your cost is pretty much fixed to produce 1 ton of palm oil, and that price has gone up. So really what happens is that this increase in commodity price would pretty much almost flow down straight to the bottom, minus any of these taxes that's going to happen, right? So in the case for WILMAR, they are actually exposed to the Indonesian market, where you actually have where they're actually discouraging export of crude palm oil, but they also have a refinery there as well. They are actually encouraging processed palm oil as well. So what happens is that a lot of the exporters who don't have a refinery, they sell it at the local market at a lower price. And that's where another gap that they are also taking advantage of. So that's an example of average selling price. So palm oil prices tend to be a bit cyclical in nature. So they're probably not at the investment grade, a little bit more cyclical, but what we're experiencing today are average selling prices moving up. So I want to move on here. Okay, so I think there were some questions. Is the average person, how do you know? Well, this is one which I think really, if you look at most palm oil prices globally, palm oil prices have gone up, but I think a lot of the stocks have not gone up in tandem. This is double, right, in 2 years in a pandemic period, right? So really, I think to kind of answer that question, how can an average person look at this? Really, you look at the business, and you must understand the business. I think that's very, very important. And don't try and understand every single business, because that's probably too much, right? Focus on what you know. And I myself personally, I read a lot. In fact, I read the announcements of companies every day, right? To kind of keep abreast to really what's going on. And that kind of give you a clue as well. And the great thing is with some of these factors here, a lot of it is public information. Where you kind of need to put that effort in is really trying to connect the dots. Yeah. So I want to talk about valuations in a while. So I want to clear this drawing here. So again, WILMAR is where I would put it, very low risk kind of company, where, every single year they make profit. Every single year they have been paying dividends as well. So let me just get my drawing here. So if you can see here, they you know, they pay dividends every single year. So very stable kind of, you know. So the question here is, you know, risk-weighted return again, right? Risk-weighted return. And if you look at this, they are profit, you know, every year they are profitable as well. So generally quite low risk, right? If prices start moving up. Okay, so WILMAR is, if you look at it, it's kind of stagnated since 2012. You know, it's really not gone anywhere. It's really only just starting to move. And you know, why did it take investors so long? So again, this might be another case of oh, you know, I'll wait for it to come back to this level and then I'll buy back again. You know, we have that mental block, but you must look at the fundamentals. It's changed quite a fair bit. 2000 to 4000 is very, very significant, right? So let me kind of clear this as well. Okay. So the next one is actually increasing capacity. So increasing capacity, I think one of the most popular retail stocks, semiconductor stocks, actually AEM Holdings on the SGX. And if you kind of look at AEM and what they've been doing, really before the share prices started moving up like this way, you kind of dig back a little bit into 2013, right? That's really when the foundations were being laid. Now, of course, AEM has its own historical ups and downs, and it was very much a kind of a turnaround business, right? So they turned it around, they made the right investments, and one of the clues, right, one of the clues into increasing capacity is that you must look at the cash flow statement and look at its investing activities. So in this case, if you look at the last 10 years from 2014 to 2025, they haven't done really significant investments except for this year. So $22 million was significant to them at that point in time. Of course, you know, they've really turned it around. And, you know, from a 5 million profit to 52 million profit, right? They also invested in the right space at the right time. Although that was probably a little bit more difficult to spot. But if you have a chance to look at your business, and if the business is adding new capacity, that might give you an indication of what is to come, right? So, you know, something that they invested in 2013, you know, really you're not seeing any movement until say 2017, 3 years later. And why, right? Typically, for example, if I was a manufacturing company, I said I'm going to invest 100 million this year to increase or double my capacity, we must also understand the context of the business, right? So if it's a factory that I'm investing in, you know, I have to procure the land, I have to build that building. Like, you know, even before one product can be churned out from the factory, you know, it may have been a 15-month lead time, right? And of course, they've got to fine tune it and so on and so forth. So that's the kind of indicators, or a very early indicators that you actually see. You're not likely going to see an immediate push. Only when the results start moving, that's really when you're going to actually see prices moving up as well. The last one, you know, I talk about new business segment, and I think this is sometimes a little bit of a hit and miss, because not all new. In fact, a lot of mergers and acquisitions typically don't work, most of it, right? But if they were worked out from their own R&D and they created their own business segment, or they bought into another company, which is an acquisition here, that gave them access to something that may complement their existing business, that is something that you may want to look at as well, right? So again, you may not get something immediate, but new business segments are typically quite exciting to look at, and not something, you know, I used to think, new business segment, that means they're moving away from the core. I used to think that, but I think, you know, looking at the world where we live in today, you know, high volatility, uncertainty, right? And you know, they call it a VUCA world, right? Businesses businesses need to react, right? And if you can see 2020, those businesses that didn't do anything or didn't manage to pivot, they're actually no longer around today. So it's how agile that you can be in your business. So a new business segment can be good, right? Sometimes it could be in the same industry, and it could be moving upstream and downstream, right? So for example, here, if you look at THAIBEV, which is listed on the SGX, THAIBEV is largely most of the profits are actually derived from not beer, it's actually spirits, right? Spirits are very much, most of it in Thailand. So you know, since 2008, 2009, 2010, they started moving kind of horizontally, not to be dependent only on alcoholic beverages. They moved into non-alcoholic beverages as well, right? So this is a bit more of a horizontal kind of business, right? And they went into Oshi here. Oshi is also a green tea. I think you guys would definitely see it at your convenience stores. That's also listed on the Thai Stock Exchange as well. So this was one example, right, of a company that's gone horizontal that have actually done well, right? And if you can see again, very low risk, there is still growth in these kind of businesses. Of course, not as quickly, but you can see that for the risk weighted return that you're getting, it's actually not a lot. So you can see every year they make profit every year, so they pay dividends. Every year they've got positive operating cash flow, right? So I'm going to draw it here. Here, if you can look at the operating activities here, yeah, every year it's positive, right? So very, very safe, right? So I move on next. Of course, if you kind of follow these guys throughout this period, you would have been fairly well rewarded in that growth stage, right? It's unlikely they will move back down to where they were originally before even the financial crisis 2007, and they continue to their business continue to grow, right? Let me just clear this. So I think HAWPAR is a kind of homegrown brand that has really done well for themselves. I'm sure all of you guys know about Tiger Balm, right? Of course, they moved away from just looking at Tiger Balm alone. Of course, they've had a few products over the years, but really they've gone very focused into healthcare and also the tourism sector as well. So you can see, they're very much an investing company, right? So they took whatever free cash flow they could generate from their existing core business, which was the Tiger Balm brand, and whatever excess cash flow they started acquiring and moving into businesses. Of course, in the very early days, they own or they still own a big chunk of UOB, right, banking as well. So I think HAWPAR was a good example to give you an idea what if you do it well in a new business segment, you're actually going to see some of those results here as well, right? So of course, if you look at some of the numbers, even with the pandemic and they are somewhat affected by the tourism industry, they are still much higher than they were even 5 years ago, right? Of course, these are all very slow kind of growth, but nonetheless, they are actually very low. It's actually a low risk weighted return, right? So for the return that you're getting for this kind of companies, you're actually not taking a lot of risk, right? And that's really what the message that I want to send out today. So there is no such thing as growth or value better. It is together, right? So if you can find something that is of value and still has growth, that's still actually very, very decent, right? Because everyone wants growth, right? Who doesn't want growth, right? Okay, so let me see what are the questions that I have here. Okay, so now I think one of the very common valuation methods is actually the P ratio. And that's not something that I use that I'm very, very in favor of, because I think when you use the P ratio, you need to understand how it works first, right? So I'm going to give you guys a few examples here. So I think P ratio is quite common, right? It's price over earnings per share. Of course, earnings per share is historical. Price is today or whatever the day that you're going to take it as. Before you use the PE ratio, you must first determine if your company is in a service line or the manufacturing line. Okay. Why do I say this? Because margins make a difference to PE ratios, right? And I'll give you an example in a short time. Now, typically service-based companies have a higher profit margin versus manufacturing, right? Because they need a lot of capital, and you talk about manufacturing kind of business, you're talking about 8, 9, 10, 12% margins, right? But you talk about services, if you do it well, 25, 30%, that's quite common, right? So for example, think of your oldest service industry you can think of today is really your banks, right? Your banks is purely a service business, right? Versus say any manufacturer. So they're all very different, and margins are also different because margins ultimately affect PE. And if you only use margin as your point of valuation, that can be a bit that might not work well for you in favor, right? So when we talk about whether you're service or manufacturing, you also must figure out whether you're in a relationship type business or you can be transactional, which means that you could be a service-based business, but you're transactional in nature. Now, what does it mean? A bank, for example, is in a service-based business and they're in a relationship business, which means they have very high recurring income. Versus say a service business that say services the construction industry. That means after you provide that service for each project, it's very project or transactional based, then you don't get it. So that's why when you have this kind of lumpy earnings, right, and lumpy or recurring and non-recurring numbers, right, that's what's actually going to affect your PE ratio. So the PE ratio, if you're just using it by itself without understanding the type of business or business model they're in, it's going to give you very, very wrong answers. Okay, so I'll give you an example what I mean by margins affecting PE, right? So for example, if year one, my revenue is 100 million and I'm a service business and my operating expenditure is 60 million, therefore my profit is 40 million, right? Now, let's say any of these one factors actually came into play, right? Actually, average selling prices started going up, right? There's big demand or increased capacity. So let's say in the second year or third year, my revenue actually increased by 50 million. So that's a 50% increase in revenue. Now, in this type of business, you actually don't expect their operating expenditure to move in tandem with revenue. So for example, plantation companies will have something similar, right? The cost to produce one palm oil, one ton of palm oil is about 400 US, 400 to 500 US, and that's not going to change much over time, right? But because prices of palm oil has doubled in price, straight what happens is that their top line has gone up, but their costs have largely remained the same. So even in this case that I said that even operating expenditure has gone up, say by 10 million, say by 16%, you're actually going to come out with something like a net profit which can double. So therefore, if you find a stock which is PE of 30 and say, oh, no, it's very expensive. But if you kind of look forward, actually, they're really selling at a PE of 15, right? Simply because of margins, right? Or how the business is actually structured. So this is exactly what kind of trying to say when it comes to valuation, right? So you only use PE when the company has very consistent results, and you should only use them if you've got at least 5-year history, right? So I want to use PE for a company that is transactional in nature. That means they're very much project based, right? Because you're gonna have low PE, high PE, low PE, and they don't really make sense, and you have to use a different kind of valuation model, right? So it's really only good if your company has a consistent net profit margin. Only then really you can use PE. So there's really a multiple of things that has to happen first before PE can be used as a reliable indicator. So I'm happy to answer any questions now, and I'm just about 40 minutes here. And I hope you guys enjoyed this. You can follow us on Facebook. So I'm on Facebook every other night under EquitiesTracker, or you can check out our YouTube channel as well. We also run an event where we analyze stocks, right? Listed on the SGX on Tuesdays, right? We call them Singapore Tuesday. So next Tuesday, we actually have another segment where we're going to talk about SGX most valuable brands, right? And what makes them valuable at 8 p.m. So do join us or follow us or subscribe and like us either on Facebook or YouTube, right? So I'm happy to answer any questions that have popped up through this presentation. Okay. So I think I've answered the how can a layman know growth factors by the time it's reported. Yeah. So a lot of what I'm showing you are things that will happen before. So sometimes they can be a little bit too early. Okay. So this may not even be reported yet. Now, it's quite tough. So if you want to look at iFAST as a business, you kind of need to really model how long some of these money or that the AUA is actually going to stay with them. If you ask me, I think we've kind of hit a new normal here with the amount of liquidity push, not just locally, globally, right? Because iFAST is actually in the Southeast Asia market, right? The push for liquidity is probably here to stay for a while, right? Of course, I know Janet Yellen said that they're going to increase treasury rates yesterday, and that there was a bit of pullback from the stocks. But I just think if you look at the stats globally, just look at the stats on the amount of money that has been created as a result of this pandemic. In fact, the last thing governments want to do is actually to slow down this recovery. So likely, if this continues, we're probably going to see higher market prices. So in the case for iFAST, the elements that you want to look at is the AUA, which is going up. As AUA goes up, and if they invested well in general, asset prices go up, that AUA can also naturally move up without any new injection of cash, right? So how do you know when valuations are rich? So it really much depends on the business, right? Very, very much depending on the business. I think there are so many areas of valuations you can actually look at. When you look at PE, for example, it doesn't take into account the balance sheet, right? And valuation is such a, I would say, a very it is not a formula that you can plug into any different businesses, right? It very much depends, right? So one way you can, if you're not sure, you may want to look for peers, right? What are they valued at, right? Say globally around the markets to give you an idea, because valuation is not set in stone. It's really willing buyer, willing seller, right? And of course, in a rare occasion, you're gonna get massive speculation where people move in very quickly and then they move back out as well, right? So fund flow as well. So one way is that you can use PE as a guide, but don't use it as your only valuation methodology, right? So if I look at some companies today that are selling at 100 PE and they are in the manufacturing business, that's, to me, that's way overvalued, right? So because how quickly can you increase your production capacity, or unless average selling price are going to go up tenfold, right? And whether this average selling price that goes up tenfold, whether it becomes sustainable, because every time average selling prices go up, competition tends to come in and kind of bring it back down to equilibrium. Yeah, so it's a lot about sustainability. So if you look at what happened to glove stocks last year, a lot of those prices were actually not sustainable. So I think there was a question on Palantir and T-Doc. So I don't think Palantir is listed on the SGX, right? So this is a SGX event. So we do have other segments where we do cover other markets as well. What do I think about new energy shocks? Oh, I think the push for renewable energy is definitely a trend that you can't stop, right? I think China has come out quite boldly and said by 2060 or 2050 they're going to be carbon neutral. So which means that you're actually going to see quite a fair bit of money being poured in. But you have to understand, solar so far has been that really weird asset class that is deflationary in nature. What I mean by this, right? There is more demand for it, but prices keep coming down, right? So solar has made a lot of rich people poorer, right? So it's one of those rare asset, or what I say, energy sources that continuously come down in price every single year, right? But it's definitely a trend for sure. Going forward, renewable energy, I think it's very clear, right? Burning of fossil fuels is definitely not sustainable. If you talk about energy related stocks, if you're talking about predominantly say oil and gas, if you look at where we are today, really, the oil and gas prices that have really moved up of recent times, which actually moved up quite surprisingly, right, to $60 odd in such a short period of time. Actually, the two main factors that kind of drive it, number one, is actually the devaluation of the US dollar. So if you look at the US dollar has actually devalued against most other currencies globally today. And therefore, the revaluation of some of the commodity prices is to capture the devaluation of the US dollar. What we're likely to see, in my personal opinion, is that a very strong V-shaped recovery because of the socialistic push, right, for money being pushed down. So that's something that if I look at it, over the long term, or even the near term, your 2 to the next 5 years, because of the kind of amount of liquidity that they push through globally, we are likely to see probably a very strong recovery. Notwithstanding, of course, in and about, you're gonna get some bouts of corrections, but I think we're probably really just at the beginning. Okay, I think that's a great question here. How do I determine new stock value based on latest financial statements? For example, Nanofilm that was just listed, I think last year, if I'm not mistaken. See, the issue with some of these semiconductor stocks that I always find is that because a lot of these semiconductor players are part of a global supply chain, so they are one part of a global supply chain, which means that what the West or most of these brand names have taken up with these supply chains is that they have this idea that I want to control everything but own nothing, which means that they are very light. They want to be asset light, right? So for example, Apple today does not want to get into any form of manufacturing. I don't want to manufacture my own chips. I don't do anything. I'm design and marketing only, right? But yet I want to control that whole supply chain. So when that happens, typically what happens with a lot of these brand names, they get all these supply chain guys to also sign a non-disclosure agreement, which means this makes these semiconductor stocks, not only are they can be valuable or invaluable, but what happens is that it's very opaque, very, very, very opaque in terms of the business model, because unless you know someone inside, you know who their client is. Typically, just reading their financial statements, they won't be disclosing who their clients are. So therefore, it's going to be quite tricky to kind of make guesswork to figure out, where their demand push is really coming from. So a lot of these companies here, that they're going to be demand push, right? Which means an increase in demand that's going to drive their growth, right? Ultimately. So whenever the caveat here is that whenever you're really looking at those, even though the semiconductor industry is very hot right now and it will continue to grow, in my opinion, it takes a lot more work, right? Or industry insights to really to be able to analyze them further, right? Because it's a very opaque supply chain, right? So some of them allow them to disclose, some of them don't allow them. So in the case for Nanofilm, I also read through their prospectus, right? Customer Z, everyone's trying to figure out who's customer Z, right? And unless you can find out where the end product goes to, or the application of end product, that's where you're going to be able to demand the growth, right? Otherwise, just based on historical numbers, understand that financial numbers are historical nature. It's done, dusted, finished, right? And where we're actually trying to look for is actually forward, right? So in the case, if you're seeing them investing in new capacity, that might give you a clue of potential demand that management is expecting, right? So you might want to use other factors. So you cannot use the demand push, try use the capacity point, right? You won't be able to use average selling prices unless you know where that demand is also coming from, right? And of course, unless if they talk about a new business segment, that will be another growth push for them. Yeah, so I hope I answered that question here. Yeah, Nanofilm is quite tricky. Let me go. I've got quite a bit of question here. Okay. When looking at Singapore REITs, are PE relevant? I I think when you're looking at REITs, I don't think PE is as relevant. If you ask me, because you must look at the business model, right? The business model is a real estate trust to manage assets. So it's actually a property portfolio. So you're looking at a fund manager, but he buys only property. So really what you want to look at is the value of those properties, and of course the yields that you're about to get. Yeah, because anyway, PE and your dividend yields kind of almost the same, right? Because the REITs have to pay out their dividends, right, to get that tax break. So so PE, because you are actually analyzing a fund, you're not actually analyzing a business. So very, very different here. Okay. Moderator, do I still have any more time, or are we about to close off? So I've been prompted. Okay, yeah. Okay, 2 more minutes. So let me see what else. let's see. Let me see what they got quite a few questions. So what about using NTA instead of PE? Okay, so when I said looking at PE, you must be careful, right? But I'm not saying discounting PE completely. What I'm actually trying to say is that PE is only one aspect, and sometimes it may not work for the business that you're looking at, right? So therefore, things like your NTA or your book value may give you some insights, right? You could also look at enterprise value as well. You can also look at operating cash flow as well. So these are different kind of viewpoints that you can look at to give you a more complete picture. Because I know a lot of retail investors, they look at PE high means they don't buy, PE low, then they buy, right? But I don't think that's a surefire way to actually value a company. It's too narrow to actually use only one metric to determine whether a company is cheap or expensive. Yeah.
Okay. Thank you, Alvin.
Thanks.
Yep. Thank you for Alvin for these sharing sessions. Next will be a Chinese panel, 创造第一桶金的旅程 by Kenny, Anson, and Joey. On the top of the website, there is a schedule button, so you can navigate to other sessions from there. Okay. Thank you again, Alvin, for the great sharing sessions, and we will see you in